What's up, guys? Crypto Wolf here. How you guys doing? In this particular video, I'm going to be talking about 5 reasons why DCA crypto strategy is a bad idea. You see, I've seen a lot of people believe in DCA, DCA, DCA. If you're not an investor, a crypto investor who don't care about the price, and you could give it a very long time, maybe a couple of years or months, then this year is good. But if you're a trader who trades for a living and you need the money to come in faster or within a shorter time frame, then this year is a bad idea. Believe me, you just end up getting your funds trapped in the market and you won't be able to do anything about it. And you may not be able to handle your daily life expenses just because you are doing DCA. DCA, you already know, stands for dollar cost averaging. It's buying a specific number of crypto at predetermined prices. So something like you could buy BTC at maybe 30k. Um, you could also buy at 25k, then buy at 20k, and buy at 15k. All you're trying to do is just to average your buying price. It looks like a good idea. A lot of people encourage it, but it's a crazy idea. Believe me, especially if you're a retail trader, not an investor, and you need to be able you need to generate profit consistently over time to take care of your life expenses. It is a silly idea. And this is the account of one of the guys who believes so much in DCA. The guy is currently on Binance. I will mention his name. He believes so much on this DCA, and look at the loss he has incurred. He's in a loss of over $1,165, and the ROI is like at 757.85%. That's crazy. He keeps DCAing, he keeps big DCAing, and that's what he teaches his followers. And look at how terrible his trade is. Why? Because he just refused to cut his losses at as when he ought to. So just look at the huge loss. Okay, imagine you're a retail trader who has a limited amount in your trading account. Let's say you have $1,000 or 2,000. Let's say you have 2,000, for instance, and you're just trying to make money off of the market to take care of your life expenses. If you are at a loss of 1,165, how much would be left of your trading account? What will be left? What will be your balance? You will have about, let's say, 800 ish or 7 something, as in left out of $2,000, just because you could not cut your losses, because you believe in DCA, in DCA, in DCA. It is crazy idea, especially for retail traders who trade for a living. So what are 5 reasons why DCA is a bad idea? First is that DCA will trap your funds and you could wait forever for it to get to your entry price. For example, whales. Okay, let me give you an example here. The whales token. Let me give you an example of waves. Let me just give you why one of the reasons why DCA is a bad idea. Just imagine you bought at somewhere and you were believing in DCAing. Just imagine you bought at this point. Just imagine you bought here. Just imagine you bought here at $9. It's now $1. Or imagine you bought somewhere here at $27. Once upon a time, Waves was trading at $64. Just imagine you bought at 27 and now it's currently trading at $1. And you've been DCAing, DCAing, DCAing. You could DCA forever and it will never get to your entry price. So it's one of the reasons why this is a bad idea. No, just look at it. Let me even see if I'll get a chart of like from from a long time, because most of these charts Okay, this is even the monthly. I forgot this is the monthly time frame. So you could see that. Okay, just imagine you bought at this one of these points. You may never be able to get to your entry price. So always cut your losses. Have a particular loss amount you can take. Let's say you entered into a trade with $500. You should tell yourself how much you're willing to risk maximum, and it shouldn't be more than 2%, which is around $10. So when it gets to $10, you should leave that trade. You will still be left with $490. That if you exit after losing $10, that's the key. So that's the first point. The second point is you could have bought lower if you closed the position earlier. Okay, just imagine, are you going to compare someone who bought waves at $27 and kept DCAing down to $1 compared to somebody who's buying waves now at $1? The person who's buying waves now at $1 has a far better chance to make a lot of money going for it to go to the upside. So if waves goes from $1 down to even $10, the person has made 10 times. So you could buy far lower if you cut your losses. Another reason is sometimes you might never recover your loss because the crypto might never recover. So you may keep DCAing down to hell. You will DCA and DCA and all of your funds will get wiped out, and that crypto might never recover. It has happened before. People who were DCAing in Luna, did it ever recover? And there are so many tokens like that that never recovered. So you want your funds to be trapped? It is better you have cash in your trading account than to be in a losing trade. It's better to have cash because if you have cash, you will still have opportunities to get into a profitable trade later. But if you're in a losing trade, you're in a losing trade and there's nothing you can do about it. And that's why you must cut your losses as fast as possible. Another reason is cutting your losses gives you the opportunity to reanalyze the chart and find what you're missing. You see, sometimes you could analyze the chart and you're not seeing certain things. When you get into the trade, you might, when you get into the trade and it hits your stop loss, you may be tempted to now reevaluate the chart and look at the chart again and you're like, oh, why didn't I see this? How did I miss this? Maybe a particular signal has appeared in the chart that you didn't see. Maybe there's RSI divergence. Maybe the pitchfork is telling you something. Maybe Elliott wave is telling you something. You might not have taken all of that into consideration before now. Maybe you missed it, or you skipped it. But when it hits your stop loss, you will be tempted to go back and reanalyze the chart, and then you see what you're missing. DCA can make your loss so big. The fifth point, DCA can make your loss so big it becomes difficult to close. And it has been proven that the more you lose, the harder it is to close a trade. And at the end of the day, you may end up losing everything. I have done DCA in the past, kept DCA into a position, and at the end of the day, the crypto didn't recover. My funds is still trapped there, and that was where I learned the hard way that DCA was a terrible strategy for a retail trader. So I hope this particular video, I hope you take it seriously and focus on cutting your losses. So immediately you enter a trade, or even before as you're entering a trade, because Binance has a feature where you could click on take profits, stop loss. You click on it, it expands. Just put your stop loss price. When it hits that price, it will execute at the market order and you're out. So don't waste your money. Don't give your money to the market with DCA. Just like this particular guy who is currently at a loss of over $1,000 just because he keeps DCAing, even using leverage on futures trade. He's on cross using 10 times leverage and he keeps DCA. It is crazy. So I believe I've said enough. I'll see you in my next video. Bye.